Hey y'all, it's day 2. We're going to be recording another journal entry. Today we're looking into accounting and finance. To be honest, I didn't really feel like vlogging today, but I'm gonna do a vlog style quick clip because I thought it was pretty cool. I booked a study room in the library, so I just wanted to show you what we're working with here. This is like the door. We're gonna be recording in here. I have a whiteboard back there. I'm not gonna use it, but this is what we're working with. So I've wrapped up my notes. I did some reading on like a startup. And I think we're gonna start. It's Friday, December 22nd, and the grind, the challenge continues. Just like a quick note is that one of the classes that I am taking right now in university, or that I finished for first semester, was about accounting. So I do have some background knowledge on it. I just want to preface by saying that this is like a basic structure framework, and more so to sort of outline and help you guide through some of the concepts that you might see in an accounting interview. Please make sure that you do your own research, and if you think I've missed anything important for the main financial statements, please let me know in the comments below. I'm more than happy to engage and respond. Amazing, cool, let's get started. Why we look at financial statements? I think that there's a lot of factors that do affect the truth and the verifiability of a financial statement, but we work with what we have, right? So, financial auditing is very, very expensive, getting a CPA to do all your stuff. We work with what we have and we get people to audit, and what we should do is to take this given information and use that to judge our company's financial position. That's to say that financial statements don't necessarily present a history of the business, but more so the current state and the current financial condition of the business. It reflects whether it's healthy or not with its spending and cash flows, etc. We are very concerned with profit performance. We're concerned with how much excess and free cash is available. And so we want to know where funds are allocated and how they're being allocated, because this is crucial information for us to be able to make good decisions on whether or not we invest or we give a loan, etc. So the first thing that we need to talk about is the income statement. The income statement is basically a list of their revenues, their expenses, whether that's direct or indirect, and what's most important, I would say, arguably, is net income, or after-tax income. We need to note that an income statement happens over an arbitrary period of time, be it a quarter, a month, a year, whatever it is. But before we sort of understand and dive into those sectors of the income statement, we must know that something has to appear within that corresponding time period. A lot of the time you're going to finance that asset. So even for a car, for example, you don't purchase it up front. Most of the time, right? On a very general basis. We need to ensure that something is done in a given period of time. And we also need to note that accounting profits doesn't necessarily equal real profit. Even though something can happen in the accounting world, it might not necessarily happen in the real world. I'll give you an example for that. We want to expense something when it's consumed, but not necessarily when the money is received. So I'll later get into this when it comes to accounts payable and accounts receivable, but what that means is you're able to purchase things on account, right? So instead of paying for a service that I want to buy, I give you an IOU, and now I just owe the person that I bought from. But on their income statement, they don't necessarily say, okay, well, because they haven't paid me yet, I'm not going to record it, right? They've still made the sale, so they're still going to record it on their income, even though they didn't necessarily receive the cash yet. Another thing that we need to know for an income statement is that these items on the income statement must impact taxes, or in other words, tax deductible. So for instance, paying interest on a debt is tax deductible, but paying back the principal on that debt is not tax deductible, which is why an interest payment does occur in your income statement, but not paying back the debt principal. So something that might influence your operating income, but not necessarily something that influences your net income. Sections on an income statement are revenue and COGS, which is basically just your total sale less out. Less in accounting words just means to subtract. So you take your total sales and then you less out, or you subtract out your total direct expenses to making that sale. So for example, if I were to be Apple, right, and I make an Apple iPhone and I sell that out, my COGS, or cost of goods sold, right, COGS is an acronym. My cost of goods sold probably includes like having gold to make the chip, having like a bunch of other materials to make the case of the phone. To be able to sell that iPhone, I needed like source ingredients or source products in order to assemble that iPhone and sell it out. But that doesn't necessarily include something like employee wages, because those are indirect expenses that you incur. What that does get included though is on your operating expenses, which is the next category. So this includes things like factory overhead. So like, for example, paying security guards or paying for like factory maintenance or like cleaning products and stuff. So if you need a factory, you're going to pay rent. If you need to market, then you're probably going to set aside a marketing budget. Because they reduce your income, but they don't necessarily affect the product, these are what's called operating expenses. So this includes anything that's related to producing sales, like a marketing budget, marketing salaries, employees, rent, or amortization, which is just depreciation. The next section then includes other income and expenses. This is where you include interest, whether you're paying it out or you're receiving it. You include your gains and losses, you include things like your impairment charges. So for example, what an impairment charge is like, you're reducing the value of one of your assets, predominantly goodwill. So what that means is like you're writing that asset down to a value of 0 because it's effectively worthless. So these are all expenses that you do incur. The next and final section then is taxes and net income. Net income basically is what's referred to as the company's bottom line. You can do some research on bottom line, triple bottom line. These are all like accounting things in the accounting world that you might want to like look into. Taxes and net income is basically the amount of taxable income that you have, or your operating income, and then you less out your taxes. And that's what gives you your net income, or like the amount of income that you have with no strings attached. So a quick note on what always appears versus what always does not appear on your income statement. The distinction then is basically, does this impact my taxes deductible? So what always appears is total sales, cost of goods sold, operating expenses, operating income, amortization, interest, gains and losses, and like other sorts of income. Income statement does not include capital expenditures, purchasing, selling, investments, like plant, property, equipment, what we just denote to PPE. We don't include things like dividends, paying principals on debts, changes in equity, and changes to balance sheets. Now, speaking of balance sheets, what we want to note for the balance sheet is that it's at a single point in time that we evaluate the financial position of any given company. The first and most important thing is it's called a balance sheet. Guys, get ready for this, because it balances, right? Who would have thought that a balance sheet balances, you know? But the fundamental accounting equation is assets equals liabilities plus equity. These two always have to balance out, no exceptions whatsoever. So keep that in mind. But yeah, the balance sheet includes 3 main categories. So the first category that includes is assets, the second category is liabilities, and the third is equity. So what do we need to know about assets? Assets are something that you can use that can net you more cash into the future, whether directly or indirectly. Side note, this is what my prof told me, cash is king. It's the most liquid thing ever, so cash is good. Just keep that in mind. Cash is good. We want cash. Also, cash does not equal money, just in case you didn't know that distinction. Because money is money, but cash is like actual physical money. Liabilities are the exact opposite of that. They reduce, leaves you with less cash into the future, whether directly or indirectly. The last thing is equity, right? So equity is like your retained earnings or your accumulated net income to date, subtracting out the dividends that you pay out to your shareholders. So basically think of this as like your savings of your bank account, whereas like assets is like your checking of your bank account. And this is how you like raise funds for operations internally, whereas liabilities is more so externally, where you go out to banks, you go out to creditors, etc. to raise funds. Now, there's a few key terms or key like areas that you should take note of and understand what they are, so please do your own research at this point in the video. But for the assets, which are divided into categories, into current assets and long-term assets, which just means that long-term assets span over a year, so like they're probably going to last for 1 year plus, whereas current assets are more so for like daily or operational use. So some of these terms include cash, short-term investments, which can be like marketable securities, accounts receivable or AR, prepaid expenses, inventory, PPE or plant property equipment, intangibles, and long-term investments and goodwill. On the other hand, liabilities, which are also split up into long-term liabilities and current liabilities, again, basically you can categorize them on whether or not they're going to be like happening within a year. So for liabilities, you have working capital loan, accounts payable, accrued expenses, deferred revenue, you have taxes, interest, or other kinds of payables, and other long-term debts and loans. Now for equity, you have things like common stock, so how much money was initially raised in an IPO, or like basically amount of money that you generate from selling your stocks out, and your treasury stock, so like how much like stock that you repurchased as a company, and your retained earnings. The next statement that we should cover is the cash flow statement. So the cash flow statement basically shows how much freed up cash you have in the company and the changes in cash that you use throughout the year. There's a positive cash flow and a negative cash flow. So negative cash flow is a use of cash, whereas a positive cash flow is a source of cash. So also note that this is going to be over a period of time, like the income statement, because this includes real cash expenses. To start off the cash flow statement, you need to have your net income, but I'll later get into that. There are things like adjustments to cash bases, so like something that's a non-cash expense like amortization. Like how do you pay amortization, right? Like if I pay for a car and I pay for the car is like mine, right? But I'm not necessarily pulling money out of thin air. So that includes like adding back or lessing out non-cash expenses that were included previously on your income statement. So things like capital expenditures or dividends, which is not reflected on the income statement, but are indeed cash expenses, right? Think about dividends, right? If I'm giving you money, that's not necessarily impacting my taxes deductible, but it is a real cash expense. So we need to display that within your cash flow statement. So usually the cash flow statement has three main sections. Firstly is the operations, secondly is the investing, and thirdly is financing. It may come in different orders, but usually we start with operations. So you're going to get cash flows from each of the three main sections. So first on to operations. You start the statement with your net income, then you adjust for non-cash expenses, and then you include changes in your balance sheet accounts. So for example, if you have changes within your accounts receivable, your accounts payable, marketable securities, your inventory, whatever it is, if you change and you use up cash or you free up cash by, like, for example, you pay back your suppliers, then you lose cash because you've taken out of your money and you've taken back the IOU and you've given them money. The next thing then is on financing. This is related to how the company is raising money, whether or not you pay back debts, you take out loans, you issue dividends, you issue new shares and stocks, etc. Right? The last thing then is on investing. So the cash flow from investing relates to investment activities. So if you like spend money buying a new factory or acquiring a subsidiary or getting new companies involved. Again, it's just very important to know whether something is a source or a use of cash. Cool. That's it for today's video. The one other thing that I do want to highlight that I did not mention in this video is the statement of retained earnings. So that relates to how much money you've accumulated, net income over time. Very, very generally, statement of retained earnings is your accumulated retained earnings, lessing out your dividends, and then adding on your net income for the year. And that's how you find out your retained earnings. That's what that is, but feel free to do some research on that. But I just wanted to sort of highlight the most important accounting topics and the accounting, like financial statement sides to accounting for today's video. And this is, day 2 journal. I think it was a pretty successful journal. I'm gonna make sure that post-production looks a lot better than yesterday because yesterday's was terrible. But yeah, hope you enjoyed. And again, as always, please let me know if there's something that I missed down in the comments below. I'd be happy to respond. And if there's something that you think I should study, please let me know. I'm gonna go back to reading some of the startup books that I started reading today for the rest of the time that I have in the study room. And yeah, I just want to say thank you so much for joining me on day 2. I hope this was useful, educational, and I hope that I'll be able to see you for day 3 of the challenge, okay? Cool. Bye guys, have a great night.